And on today's show, which life insurance chassis is best? Part 5 of this week's series on life insurance for tax-free income with co-host and nationally recognized product expert, Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmouth. Let's get down to business. Well, welcome to day 5, Mike.
Great to be here.
This has really been a great tutorial all this week. I mean, I always learn stuff when I'm with you, and I'm sure that our advisors are picking up on some of the real beauty of why we sell this and looking at the math as best as we can in the most objective way. I've been doing the caveat on our side of this equation for a long time, thanks to 408B2 and other areas of the code where we've really had to now go full disclosure and, of course, throwing in the statement of information fee for mutual funds. We're now getting a pretty good shake now and pretty good idea of where we fall out. Before we get into this, let's talk about, when we're talking about chassis, I want to talk about indexing right up front just because it's so popular. Mike, walk me through this slide. This is the lost decade. Now listen, when I say this, it's the lost decade depending upon what you were into. But if you're into indexing, maybe not.
Yeah, absolutely. This is the power of being in an indexed. And here we have negative years where didn't lose any money. 0 is your hero.
Even though we had 3 loser years in a row.
Yeah, but here's the real impact. We've gone down significantly here in 2003, but we have an up year. We increased by 26%. All right, now, if you're in a mutual fund or any type of variable sub-account, you're still down a ton at this point in time. However, because you went from point A to point B in that given year, you maxed out your cap at 12% here. So you had growth, even though that you are still well below what your original basis is. We do that year by year, and when we have 0 years, we lock in all of those gains so that our effective tax yield, or excuse me, our effective total yield is about 63%. Now that's the accumulation phase, but certainly the distribution phase is a little bit different.
Yeah, and by a little side point, look at the spread between your total effective yield negative on your funds and your effective yield on just
Almost
indexing.
90% difference.
That's accumulation. Good point. Distribution is a huge issue during this time. What if you were taking distributions? I've heard so many people say withdrawals to basis is so blasé. It's so yesterday. But let me tell you something. 4 out of the 10 years in the lost decade, if you were taking actual income, you will want to take withdrawals to basis. You need to have basis in reserve to use it. I'm all for participating loans, and I want to use them every chance I get. But in a loser year, I'm taking withdrawals to basis. The expense load of the actual policy, hopefully you've managed that as we've been saying all week, but the loan cost as well. I need to make sure I manage it to the best I can, and one of the greatest tools to use is withdrawals to basis. So be careful, heads up, when you're dealing with a year that it's a down year and you're taking income, you got to be very careful. If you would have taken policy loan, participation loans, this would have been a bad deal. One other final caveat on this slide, we're only talking about the gross receipt. We've never talked about policy expenses against this return. But I just want to say that's our number, 6.3, if you looked at it on an annual basis. I love this slide. It really brings home the lost decade and the power of accumulating in an index product. Mike, let's go back down and look at this. This is a really great piece put out by Lincoln. They did a huge study. I want you to walk us through what this really means because this is so powerful. The historical returns of a 1-year point-to-point index account. I'm looking at that number, 100% probability at 5.5%.
Yeah, isn't that a great number? And this isn't just a snapshot. This is 285 rolling periods of 20-year periods. So if you stay into this particular type of policy long term, and you have 100% probability of having a 5.5% rate of return. When you think about no risk to your principal, and if you could walk away with 5.5%, what a great option. And if you even were a moderate or an aggressive investor, you still got an 85 to 90% chance of having 7%. And again, because you can manipulate basis and tax-free loans, you get tax-deferred growth, which turns into tax-free income distribution. So this is a great piece, shows you the ability of a carrier to have proper cap strategies, proper pricing, and deliver value to the client.
Keep in mind, of course, this is no indication of future performance, but historicity based on this. This is a huge piece, and I love this brochure, and I really appreciate it. Well, before we leave, I want to show this. We did kind of show this yesterday, and we're back to that same alliance that we were looking at yesterday. Look at this. We're looking at putting in $10,000, $57,000 coming out tax-free, and again, my little remark of yesterday, all the way out to age 120, even though I kept asking the computer, just go to zero, I'm going to get that money. But Mike, you actually talked about something off camera about the death benefit.
Yeah, this is interesting, and I compliment Steve because of the way that he designed this particular policy, and it speaks to why you've got to go back and do annual reviews, take a look at, are you at that maximum amount of cash value versus death benefit? But our death benefit really continues to increase. Now, we manipulated the policy downward at this point in time, but cash values continue to increase as well as the death benefit, and that tells me that we have a properly designed policy.
We're making the DEFRA corridor, that spread between the death benefit and the cash value, as small as we can. The smaller I make it, the lower the cost of insurance. This is a huge idea. When we come back from the break, we're going to talk about some of the other chassis that you can look for depending upon your risk tolerance right after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with my co-host, Mike McGlothlin. Mike, let's look at some of these illustrations on these other chassis. In the first segment, we talked about indexing, which is the number one popular one, but I'm going to bring a little attention here. I'm going to use the venerable Mass Mutual. It's one of our top blue chip carriers in the United States. They just happen to be ranked number one on income. Number one on income. Now, I could have bought the base policy, but I've noticed the strategic use of the term rider and their paid up additions rider, where you can deposit money almost directly into a side fund practically. Those numbers are huge. And here's an issue. Why would you use this, Steve? Because I have a lot of clients that are saying, Steve, I'm a conservative client. I don't want to do indexing because I could get 1 year, I could get nothing. And I'd have policy expense charges. At least with here, I got some kind of guarantees here. I could either use the base policy, or in my scenario here, I'm using a combination of their PUA rider and their term rider. The thing I like about this is, if you're conservative, most people are using the benchmark of 10-year treasuries. Mass Mutual, in their illustration for income, has done outstanding against the 10-year treasuries. So if you're a conservative person, especially if you're dollar cost averaging, you just don't have a big chunk of money, but you have nice cash flow going on, and you're very conservative, this could be a play. Talk a little bit about this, Mike.
Well, first of all, I want to key on 4 words that you said. Actually, the same word probably 4 or 5 times was conservative. This goes back to Monday's show about having the right risk tolerance. When you have a conservative person that wants guaranteed growth, this is the type of policy chassis that you really want to have here. And again, we've got a good dividend paying company here. We have our base value and then our total cash value of paid up additions, like Steve talked about, kind of a side fund of just building up cash, and we're trying to minimize the death benefit. But what happens here is the term policy, although it eats away in some of the cash value, certainly a drag like we talked about on Wednesdays and Thursdays show. The reality is it allows us to minimize that cash building portion of the plan, and then we can maximize and dump in as much dollars into that while still giving a suitable amount of protection, which then converts so that we've got our guaranteed insurability, and then puts us into a higher dollar amount or higher face amount so that we can pump in more cash value into that to meet guidelines.
In this illustration, using this was a really good number, because I looked at indexing, current assumption UL, and VUL at that 5.5 S&P index we talked in the first, and this actually won because of the way they set up their contract. Now, little heads up, I cannot, and this is one of the shortfalls of the software, but think about this, I didn't drop the term rider off. And I can in real life. So this number would even be even better.
Yeah.
So I want to think about this. When you're conservative and you're looking at this, participating, and I just happen to be showing you the number one company in the blue chip mutual companies that actually use par whole life for an income. Now, interesting, current assumption UL has kind of went down. It was the beginning. It was the entree in 1984. It's kind of secondary. I mean, if you're an aggressive, you're doing variable. If you're indexing now, you're doing that because you see the beauty of protection. And participating whole life, is there a place for current assumption UL right now?
Again, I think there is. When you do that risk tolerance, it's still conservative. You've got, where this really plays is for that client that wants flexibility. Where we talk about someone that's going to have a large amount down the road, possibly inheritance, bonus opportunities and part of deferred compensation that's going to come out, and they want a place to build that up on a tax-deferred basis after that. The flexibility of a UL policy is really going to come into play with clients. In today's low interest rate environment, though, Steve, it's not going to build up as much cash as some of the other alternatives. But at the same time, if you believe that interest rates are going to go up over long periods of time, this is probably going to be a segment that would react quicker than some of the other opportunities.
So this could be a play in regards to arbitraging the quickness of rates increasing. And if it happened, this may have an advantage over the par contract. Well, that's a good point. I mean, something to think about. Now, a lot of people are looking that are more aggressive. Like I went to the Thunderbird School of Management a couple of years back. I saw so many millionaires, some billionaires sitting in the room looking at the best plays, and the two most popular seminars of the entire week were captive insurance companies and VUL. Why? The tax issues were huge, but they also want to manage their asset allocation account. So they were looking at either private placement or traditional sub-accounts in this. For people who are really aggressive, who have long time spans, who are high tax brackets, and say, Steve, you guys don't get any dividends with your S&P on your indexing. Even the best ones, even if you went to the Russell 2000, I just don't get dividends. I wonder if I got dividends on this and what the rate of return would be, and I'm willing to take on some risk. Because there's risk here.
Yeah, the key word there is risk. And again, when you go back to your risk profile, or really that aggressive investor probably belongs in some type of VUL where they can choose. They can manage, along with that advisor, actively manage that asset allocation to match up with their overall risk tolerance of their other portfolio. But for a portion of their income, their guaranteed income that they want to have on a tax-free basis, this is a great opportunity to push some dollars into that portion of the portfolio.
So when we're looking at the four chassis, all based on my risk tolerance, the first thing I always think about, well, what about taxes? Right there, that could be the universal play for everybody. I just don't want to pay any more taxes.
Yeah.
And I don't want my Social Security to be taxed because of this investment. Well, that's another positive. But now I have four different ways. People think we're not a diverse product line, and really, there's so many sub-accounts offered in variable. There's so many indices, foreign and domestic, offered in indexing. And there's this two different chassis. You could go current company for regular interest rate, current assumption UL, or par whole life. So this is we have quite an inventory and a menu. Any closing thoughts?
Yeah, just, the reality is even in a VUL, you have so many different options. As you get more conservative, you can back off your investments. But one thing that you got to take a look at is what's the carrier selection? Is there enough diversification inside of that policy for a VUL to be maintaining not only now, but in 30 years from now?
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our site at downtobusiness.ashbrokerage.com. Want to email me? steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. I'll see you next week.